Very good afternoon and welcome to our webinar for today called How to Invest in 2016. In 2 minutes, we're just going to spend the next 8 or so minutes just giving what I would like to call 2 minutes pearls of wisdom. And I suppose in your context as a fund manager, Roger, just tell us, do you need diversification if you're buying the top stocks? Because we talk about A1, A2, B1, B2 stocks, which are good quality stocks. Now, if I'm investing in good quality stocks, do I need diversification or what's the go there?
As a minority shareholder and a passive shareholder, you don't have control of the business that you're invested in. And I can tell you this from painful personal experience. There was a stock many years ago that I bought called, for our clients, called the Reject Shop, and we bought that at just after it floated at $2.40. The share price subsequently went to $17 or thereabouts, and I can remember on behalf of clients that position grew to about 44% of the entire portfolio. Now, through sort of a sense of desperation, we managed to reduce the size of that position in the portfolios at the time, but the share price still subsequently collapsed when a new CEO came in and didn't do such a great job of running the business. Retailers tend to require merchants running their business, and this particular individual was a corporate animal rather than a merchant, and so the share price subsequently fell dramatically. Now, it's good that we took some profits, but from that experience, I've learnt that there are things that can happen that are outside the control of even the very best analyst. To remember, you're an analyst, you're not a business manager, you're not running the business. And for that reason, it's very important to diversify. So we can have 10 or 7 or 10% of the portfolio in an individual stock, but we never have. And the most we would ever get to is about 6%, and many of our positions are 3 or 4% of the portfolio. That means that we need to follow more companies, but by the same token, it means that if any particular event outside of our control occurs that is adverse, it's not going to have a permanent disruption to the growth of our capital.
Okay, thanks. Now, Chris, let's just focus on self-managed super funds. And again, with that same thing in mind of 2-minute pearls of wisdom, how much, what is the ideal number of stocks to have in your portfolio? Let's start off with that. Say I've got 20,000, 50,000, 100. What's the ideal number?
Yeah, ideally we would say let's focus on 15 to 20 stocks, but what's important to consider when you're looking at that, Shepard, is balancing your transaction costs against the number of stocks. So if you've only got a fairly small portfolio, say 20,000, you might only want to invest in 10 stocks. That would give you an exposure of $2,000 each, which is probably about the smallest size position you would want to have. The other thing, though, it's important to look at the correlation between your stocks. And by that, I don't mean some convoluted mathematical thing. What I mean is just look at the businesses in your portfolio. If you've got, say you've only got 5 stocks, but 4 of them are the banks, well, you're not really diversified at all. But if you've got 5 completely different stocks, well, then you're starting to get a measure of diversification into the portfolio. So I think it's really important, and I touched on this in my opening comments, that diversify across a number of different metrics, be it the size of the business, the industry of the business, and the geography, of course, of the business. Look to really spread your risk by focusing on how the businesses in your portfolio are different and won't be, if there's a particular adverse economic event, it won't impact all of those businesses in exactly the same way.
Can I just chime in there with Chris's comments? We limit our exposure to individual sectors to 20%. So even though an individual company can have a maximum position size, we also have maximum position sizes in sectors, for example, financials or retail, and that helps to mitigate some of the risks associated with adverse macroeconomic impacts on individual sectors.
Yeah, what I might just do, just to go into that concept a little bit further, Roger, is I guess people might be interested to see, this is my actual portfolio, so I'm putting myself out there for a minute, and what you can see there is that little pie chart shows you how my portfolio is diversified across the different sectors. You can see, this is by no means the ideal portfolio, but it's done all right. We're up 29% over the last 12 months, or 142% since inception. What I wanted to highlight here is these little sectors here. You can see that the red means it's gone down in the last day, and the green means it's gone up. But what I can also do, I can click on this little button here, and that'll take me to a list of these stocks that are in my portfolio. And then what I can do is I can edit the columns, and I can pull up the sector, and I can indeed go one step further and pull up the industry, save those columns. And so what you can see here is, if I just sort by sector, whilst there were 4 businesses in the services sector, if you look at them, one's personal services, it's Flight Centre, it's a travel agent. One's schools, 3P Learning, they provide educational software. One is advertising, REA Group, the realestate.com. And one is retail, Nick Scali, making furniture. So whilst at the very top level they may look quite similar, all being in services, they're actually all very different businesses. So that gives you a bit of an idea, if you look down that industry column, of how I've chosen to diversify my portfolio.
In a minute or so, what is your main challenge of running a self-managed super fund?
Well, the challenge was always, Shepard, is how to make money. But that aside, it's all about how to manage your time in the midst of a busy life. And that's why you really do need a tool like Skaffold, and you need a systematic process. Nothing beats having a systematic process that you can follow through and just have some rules. It makes decisions for you ahead of time.
Okay, and very quickly, Chris, we asked you before how long you hold shares for. Can you just run us through that?
Yeah, sure, Shepard. The answer to that is that I hold them for as long as they remain an appropriate investment. Now, I know that sounds vague. The answer is, the longer the better as a general rule, but never be wedded to a particular stock. It's important when circumstances change to be willing to change your investment. And I'll just give a couple of quick examples, if you like. Again, harking back to my own SMSF. Just recently, I sold ANZ. Now, the reason for that was it shifted from an A2 to an A4 stock. So if I just pull up ANZ, you can see I'll go to the Skaffold screen. You can see there that it changed from an A4 to an from an A2 to an A4. So that was a reason to sell. Another reason to sell might be that the investment has done exceedingly well, which is obviously is the best reason, and you now believe that the value of that business the price of that business far exceeds the value. So if I pull up Flight Centre here, you can see back here, about here it was, in November 2013, I sold my Flight Centre stock because I sold it around $52, and then I subsequently bought it again about here. I can't quite get my mouse on it, but yeah, here, at around about $39. Now, unfortunately, I didn't quite pick the bottom, but that's life. But you can see the logical reason there was that it was now trading at a discount to its intrinsic value. And I guess the third and final reason for now, Shepard, is that sometimes just a better opportunity presents itself. So earlier in the year, I held Macmillan Shakespeare, and I'll just load that up into this compare function. And I decided to sell Macmillan Shakespeare, not because I hated it, but simply because Nick Scali was a better opportunity. And you can see on this summary screen that, Macmillan Shakespeare is not terrible, but Nick Scali's got a lot of better attributes. And likewise here, Macmillan Shakespeare fell away to an A4, whereas Nick Scali is an A1. It's only been a short while, but the nice thing is that Macmillan Shakespeare's fallen about 13% since I sold it, whereas Nick Scali's up 20%. So it turns out that was a good choice, at least in the short term. And of course, to keep tabs on all of that, I use Skaffold's alerting function, the daily email alerts, so as I don't have to spend a lot of time looking into it.
Thank you very much for joining us today. Thank you very much, Roger, and thank you very much, Chris.
It's a pleasure.
And see you guys next time.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. With so much information out there, how do you quickly sort through the companies worth investing in and those to steer clear of? Skaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Skaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Skaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Skaffold for a test drive today?